Ever wonder what actually happens to the money you deposit at your bank? You might think it's just sitting in a high-tech vault waiting for you. But why would banks pay you interest just to store it? The truth is far more interesting. Banks are actually creating money every single day. Today, we're breaking down the money-making magic of the banking system. Let's start with the business model. Banks are intermediaries. You give them your savings, and they pay you a small interest rate as a thank you. Then they take that same money and lend it to businesses or home buyers, but they charge them a much higher interest rate. That gap, called the spread, is how the bank pays its bills and makes a profit. But wait, if they lend your money out, what happens if you want to withdraw it? This is where fractional reserve banking comes in. The law doesn't require banks to keep 100% of your cash on hand. Instead, they only keep a small fraction, usually around 10%. This acts as a cushion for daily withdrawals, while the other 90% is sent out into the world to work. Here's the magic. If you deposit $10,000, the bank keeps $1,000 and lends $9,000 to someone else. Now, your bank statement still says $10,000, but the borrower has $9,000 in cash. Suddenly, there's $19,000 in the system from a single deposit. This cycle repeats as that $9,000 gets deposited elsewhere. This is how the money supply grows without the government ever printing a single new physical bill. Now, textbooks often say deposits create loans, meaning banks need your money before they can lend. But in the modern world, it's often the opposite. Loans create deposits. When a bank approves a loan, they simply type numbers into a computer, creating a new deposit instantly. They worry about finding the reserves to back it up later. So why don't banks just create infinite money? There are two big speed bumps. First is profitability. A bank won't lend to just anyone. They have to account for operating costs and the risk that a borrower might not pay them back. Second is capital requirements. Banks must keep a certain amount of their own profits as a safety net, rather than giving it all to shareholders. If this system sounds a bit risky, don't worry. Your personal savings are protected. Most banks are insured by the FDIC, and government organization that guarantees your deposits up to $250,000. Even if the bank runs into trouble, your money is safe. The banking system is the engine of the economy, turning simple deposits into the fuel that starts businesses and buys homes. If you learned something new today, let me know in the comments what finance topic we should tackle next. Thanks for watching.